Why would you ever refinance into a 30-year fixed mortgage when you can be mortgage free in less than 6 years? I just showed a client that had 27 years left on a mortgage, how she could pay it off in less than 6 years. Same house, same income, nothing's changing, except we're in a better loan. Instead of a traditional refinance, we're going to put her into a first lien HELOC. And this is going to be the total game changer that you need to understand. This loan gives you way more flexibility and the ability to pay off your home faster, give you access to capital in your home, and help you build wealth. You end up paying tens, if not hundreds of thousands of dollars less in interest over your mortgage. This is a total game changer once you understand this concept. Here's what her loan looks like. She owes $182,000. House value is about 220 today. She's in a 30-year fixed mortgage at 5.625. She's been in that mortgage currently for about 31 months. Her net monthly income comes out to about 4,700 bucks a month. She's got about 8 grand in checking and savings right now. So all we're doing is moving that extra cash into our HELOC for the
By the way, isn't it crazy? All that rigmarole in terms of 4,700 bucks a month, paying that mortgage. She's only got about $8,000 to $10,000 of savings. See, that's the challenge with a lot of people today. They put all that money inside their house, they buy a car, everything got going on. But when it comes to themselves, they're paying everybody else, but they're not paying themselves. They're not saving and investing for themselves. That's the downside. Typical homeowner here that we see when life comes and hits hard, they don't have enough money for emergencies. Continue.
time being. And no, that doesn't mean she doesn't have access to the money. Remember, this HELOC gives you access to your equity for 30 years. So that $8,000 is still accessible in the event she ever has an emergency. If anything, I'm going to put more money back into her pocket and I'll show you. So after paying all her bills for the month, again, we got 4,700 bucks going in. She is left over with about $2,000. This will now give us her current mortgage. She's got about 27 years left. Here's our HELOC. We're going to pay off that same $182,000 balance on a refinance, paid off in 70 months, saving her $129,000. That $129,000 gives us an equivalent of about $22,000 a year in interest savings. Or if you wanted to break it down by month, she's saving about $1,800 a month just in interest alone. And again, average interest rate on this HELOC is 8.3%. But because this is not your traditional mortgage and we're paying simple interest on this loan, we're paying back $45,000 of interest. This is the one concept that so many of you just fail to understand or even want to acknowledge. We're paying $45,000 worth of interest. That's the equivalent of your effective APR of 1.5%. My client doesn't have to work any harder, doesn't have to pick up any side jobs, side hustles to make more money to pay her house off and save over 6 figures worth of interest. She just knows how to use the first lien HELOC to be successful. So, do you understand it? Do you want to learn how to beat the bank at their own game? If you do, follow me for more tips.
Yeah.
Why would you ever
So, okay. So here's a couple things that come across my head if I had a conversation with this guy. Number one, HELOCs are dependent upon the current interest rate. So HELOC interest rates will change. Now, if they drop the rates, good for the client. If they increase the rates, bad for the client. That's number one. Number two, you're still beholden to whatever the bank says about HELOCs. You know, on Netflix right now, they've got the 20-year anniversary of Hurricane Katrina. I clearly remember when people are saying, get out of the path of Hurricane Katrina, get out of New Orleans, and all these folks who had all this equity in the house, their emergency fund was their HELOCs, their home equity line of credit, which, by the way, this guy's not editing his, I know his editor's doing this, his job, but listen, it's your brand, but HELOC is HELOC, not HOLOCK. Anyway, little semantics. But it's also important if you're educating people about finance, the education of the actual wording is also important for them to know. But Hurricane Katrina's coming in. They're saying, everybody get out of Dodge. Where's your cash? Where's your cash for cash? Homeowners, so, I got it in a HELOC. I got it in a HELOC. Home equity line of credit, HELOC. And they had their HELOCs on credit cards. It's not like they had to go down to the bank and take out checks or whatever the case may be. The banks at that time were able to help swipe the card for access to their home equity line of credit. Here's the challenge. Home equity line of credit is the ownership of the bank. It's their ability to say, you can take out your money based on our rate of return, based on our approval. It's theirs. In other words, your equity that you're looking to access through a home equity line of credit, it's still based on the bank's approval. So guess what happened when Hurricane Katrina was coming down? They froze all the HELOCs. No access to any of the cash equity that's inside the property. Now, you might be mortgage-free, but you got no cash. What good is it to be mortgage-free, debt-free, mortgage, not be bound by a mortgage, but you got no liquidity, you got no control, you got no transferability. And that's why a lot of people got hurt from a financial perspective. So same concept, but there's other ways to do this without putting inside a HELOC. You can put this according to the paper written by the economist of Federal Reserve Bank of Chicago. When I interviewed him in 08, 09, he says, put your money inside a tax-deferred side account, which could be a combination of Roth IRAs, which could be a combination of cash value permanent life insurance, which could be a combination of just a side bucket that you can control. Okay, like a high yield savings account that you can control, not the bank, not a line of credit. The company can cut it off. Same thing too with the LA fires, the Palisades, the Malibu fires, the other hurricanes in Florida. When tragedy comes, when natural disasters come, insurance companies, property and casualty insurance companies are cutting people a check for the rebuilding of the home, not for the value of the house. Keep that in mind. So if they're cutting you a check for the rebuilding of that home, not for the equity of the value of the property, the equity that's inside there, that should help you understand that equity inside a house, although it looks good on paper, is not necessarily yours unless it's in your name in a liquid side account, mainly a Roth IRA, cash value policy, structured for high cash value accumulation, high yield savings accounts, again, that you can control. So what are your thoughts? Do you accelerate the pay off your house by paying down the mortgage through a HELOC? Or traditionally speaking, like the way he was looking to get you away from just a traditional 15 or 30-year mortgage? Obviously, he had a good alternative to it as well. This might be an area that you can find a solution with, but I like liquidity. I like control. And more importantly, I like access. And I like making my money earn more money, because how much money does the equity in your house put in your checking account every month? Anything? Zero? That's why a house is not an investment. Your home is not an investment. It's a place to raise your family. It's a place to create experiences. And so another conversation that people are having is either renting or owning for the rest of your life. You rent for the rest of your life, you own for the rest of your life. What do you think? So many things to talk about on this topic when we continue with these reaction videos, because this is a conversation of why I wrote the book, Keep the Keys. Because one thing to get the keys, but something to keep the keys, where you have liquidity, you have control, you have access, and you're driving it, not the bank. You're the bank. Which would you prefer? Put it in the comment section below. What are your thoughts? That being said, for more reaction videos like this, subscribe to our YouTube channel, 7 Figure Squad. And for other conversations about faith and finance, other playlists we have here too as well. We combine that here on the 7 Figure Squad YouTube channel, where the looking in the perspective of finance is different from the lens of a Bible, from the lens of a layperson in a church, from the lens of how Scripture encourages us to look at our relationship with money. That being said, from Dallas, Texas, I'm a money smart guy. And until we meet again, continue to live smart, continue to love smart, and be money smart today.